Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out what companies are really up to. Today we're diving into ZyVersa Therapeutics' latest annual report, and let me tell you, this one's a bit of a roller coaster. A bunch of small companies trying to make a big splash, but it doesn't mean they'll stick the landing. We'll break down whether they're on track or just spinning their wheels. Fasten your seatbelts. This report tells the story of a company betting big on some pretty complex science, trying to turn cutting-edge research into real medicine. They're targeting tough diseases, but that also means they're facing a ton of risk. Can they pull it off, or will the science and finances crumble under pressure? That's what we're here to decode. ZyVersa is a biopharmaceutical company trying to make new medicines for chronic kidney and inflammatory diseases. They've got two main projects, VAR-200 for kidney problems and IC-100 for inflammation, both still in the early stages. What's interesting is that they are trying to repurpose existing or already known medicines for new uses, which in theory can greatly reduce risks. Their strategy is to take these platforms and develop them for multiple uses, maximizing their potential, which is a good sign of a long-term strategy, but they need cash. They are also placing themselves in a growing market. The global kidney drug market was almost $18 billion in 2024 and expected to reach $30 billion in 10 years. What's driving the growth? Obesity and diabetes, plus some new technologies that help us understand kidney disease. But of course, there is no guarantee that any of this money will end up in ZyVersa's bank accounts. ZyVersa doesn't have its own manufacturing facilities. Instead, they rely on third parties to make their drugs, which is a double-edged sword as they have limited controls, but they can scale their development rather quickly. Now let's talk about the less shiny stuff, risk factors. It is a very long list, but here are a few interesting and critical points. Their product candidates may never be approved and the company has no revenues. We also have to remember the very competitive market landscape for a business like this. This is also a smaller reporting company and an emerging growth company, which has implications for reporting requirements. As of March 2025, they had about 2.6 million shares outstanding. The company also did a reverse stock split recently, and more on that later. Reverse stock splits are generally done to artificially increase the value of a share to remain on a stock exchange. Here's where it gets interesting and the numbers start to speak. The company impaired its goodwill and a large portion of its research and development assets. In other words, they cut their losses and the future of these endeavors looked poor and were written down significantly from the previous year. ZyVersa hopes that the global anti-inflammatory biologics market, that is over $100 billion in 2024, will help them get a slice of that pie. A lot of focus is placed on combining their treatments with the already successful and trendy GLP-1 drugs such as Ozempic. Let's look at how they are doing financially. XT in research and development, $1.7 million, add on 44.5x significant decline in operational spending. Net cash used in operating activities was about 7.6 million, which, believe it or not, was an improvement from almost $9 million the previous year. But it doesn't sound great. And then comes this sentence, and I quote, "We believe that our current cash on hand will only be sufficient to meet our anticipated cash requirements on a month-to-month basis," end quote. This is never something you want to hear. Checking the balance sheet now, and we can confirm a working capital deficiency of over $9.5 million, and that is, of course, not great. The auditors are raising a big red flag in their report. They say there's substantial doubt about the company's ability to continue as a going concern. That's auditor speak for this company might not be around in a year. It should be mentioned as a standard practice for businesses that operate internationally. There are a set of anti-corruption laws and guidelines that the company must adhere to. Like any drug business, they have to worry about healthcare regulations and compliance, which is always a big risk. As it is common with penny stocks, there might never be an active trading market for their stocks, which makes everything more difficult and volatile. There are numerous things relating to their IP that could go wrong, including infringement claims. The company has a good amount of stock options for top employees that they will be able to use in coming years. Checking how the stock ownership looks, we see the executive team has a small percentage of ownership versus a larger institutional investor. Their internal controls over financial reporting were ineffective. They're working on fixing it, but that's definitely something to keep an eye on. The paperwork is piling up with new and amended financial protocol requirements that the company is dealing with. To add to the problems, the company did another stock offering for $2 million to get even more immediate funding. So what's the story here? ZyVersa is fighting an uphill battle. They're in a promising field, have some interesting technology, and the company is trying to make money with it. However, the financial situation is definitely worrisome, as they are trying to make every penny count to try to stay alive. The company needs some serious good news, whether that's a successful trial or a major partnership to turn things around. The road ahead is a risky one, and this is a business that only a very specific type of investor would be keen to participate in. It's a moonshot, plain and simple. Thanks for watching. Please remember to subscribe, like, and comment with your thoughts.